VAT, it's one of my most popular topics that people ask about, because it is actually quite a confusing tax, and there are a lot of things that you need to know about it being a director of a company, when to charge it, etc. So I pulled together this session, VAT 101, 10 things you should know. The agenda for today will be, I'll briefly explain what VAT is. We'll go through when you need to register and how to register. We'll go through the charge to VAT, so when does something fall under the charge to VAT. We'll go through VAT rates and the categories of rates and what type of products and services attract the various different rates. Not everything is a standard rate. The treatment for VAT on goods, the treatment for VAT on services. Then we'll go through Intra-EU supplies and the VIES reporting system. We'll go through filing obligations, how to complete a VAT return. So I'm aware a lot of you will be startups who won't have a budget for accounting, but will or may need to do VAT reporting. So this will just be a handy way of learning how to do your own VAT reports. And then lastly, the penalties for non-compliance. So why it's so important to be aware of VAT for your business. Okay. So to start off, we'll go on to what is VAT. So VAT stands for value added tax. It's basically a sales tax or a tax on consumption. It's added onto the value of goods at every stage of production and distribution. So from the farmer to the fork, as I say, VAT will be charged and reclaimed all the way up that value chain, all the way up that supply chain until it hits the end consumer. And ultimately, it is the end consumer who pays VAT, not your business. Your business simply passes on the charge and collects and remits it for revenue. As a business owner, you do have to be aware of your obligations under the VAT Consolidation Act 2010, to be technical about it. And you do have to report and remit VAT to revenue via ROS.ie, you or your accountant, but you are responsible for doing it or getting somebody else to do it. So to move on to registration. A lot of people don't know when they need to register, and basically, in a nutshell, you only need to register once you pass a certain sales threshold. So if you're selling services, that threshold is €37,500. If you're selling goods, the threshold is €75,000, and the reason for that is because goods cost money. So you're really only, most people who sell goods have a gross margin of about 50%, so that's why it's double the threshold for services. Very important to note that this threshold is the accumulated amount of sales over a 12-month rolling period. It's not linked to the annual tax year. It's not linked to your company's tax year either. It's accumulated over a 12-month rolling period. So if at any time, let's say between March 2019 and March 2020 or 2021, you have sales that surpass 37,500 and you sell services, you must register for VAT. It's you have to just register. It's by the law. You can, however, register voluntarily, and you might be wondering, why on earth would I register voluntarily for a tax that's going to cost me a lot of money? Well, there are two good reasons to register voluntarily for tax, especially if you're a startup. Number one, most of the time, any of the startups I've worked with anyway, have spent an enormous amount of money before they even sell anything. So you are essentially paying for VAT as an end consumer of those products if you're not passing them on yet through the form of sales. So if you register for VAT early, you can get a refund of all of that VAT, and that will help with your cash flows and help with your profitability. So I always recommend for startups that are building or looking to scale that they would voluntarily register. Now, having said that, you must also take into consideration that it might cost money to register and file VAT returns if you're hiring an accountant, for example, to do it for you. On top of that, another good reason to register is because at some stage you will, if you're a business looking to scale and be profitable, you will probably surpass those threshold limits. And if you do, you might have regular recurring customers who you charge €100 to, Then you surpass the threshold, you have to register for VAT, and suddenly you have to charge those customers €121 or €123 normally once the VAT rate has gone down. So that you might have very unhappy customers if suddenly 1 month you're charging them 100 and then the next you're charging 121. So it's better to just register straight away, or at least if you're not going to do that, set your prices as if they did have VAT on them, so that when you do have to register, you're not taking a hit in real terms to your business. So how to register? Well, you can use form TR2, and this is available on the Revenue website. This is about a 6-page document that you fill out, and you can email into Revenue, or you can post it into Revenue. Or you can do it online if you have a ros.ie account, and I'd highly recommend you do it online because it's a lot easier and it's a lot quicker and a lot easier to get registered online. So if you have a ROS account, once you log in, you'll see a screen similar to this. And if you scroll down or control find on your screen and look for managed tax registrations, you click that link. It brings you to this page where you can register for various taxes. If you look at value added tax and click register, it'll bring you to a form that asks you a number of questions. And these questions will be the date that you're looking to register, the accounting year-end date of your business. So most businesses have a year-end date of the 31st of December, but in reality you can pick any date to be your year-end date. The registration date is the date at which you had to register or you are electing to register, and normally it's the start of any 2-month period. So 1st of January, 1st of March, 1st of May, etc. You have to choose what basis you want to register for VAT on, and that's on a monies received basis or an invoice basis. The difference is a monies received basis is when you physically receive the money from your customer, versus the invoice basis, which is you pay VAT when you invoice the customer. So you could have a case where you need to pay the VAT element of an invoice over to revenue, but you haven't actually collected the cash from your customer. That's the invoice basis. So I'd always recommend that you go on the monies received basis initially, and later on you might migrate onto the invoice basis once you surpass the limits, which is essentially selling more than 2 million, in a year, or you have less than 90% cash sales. You have to give your expected turnover figure for the first 12 months. So you say I'm expecting to make sales of 50,000, 75,000, whatever. You'd have to put that in. If you do put less than 37, if you put less than the threshold amount, they might come back and query it. So it might be a good idea to just put in above the threshold limit, just so that they don't come back and query at that point. They'll ask if you intend on supplying or purchasing goods or services from the EU member states, from other countries and other EU member states. And given the global nature of trade at the moment, I'd say it's highly unlikely that you wouldn't be trading with other EU countries. So if you're selling goods or services, you'll need to tick those boxes, and if you're buying goods or services, tick those boxes too. You have to give a reason for registration if it's below the threshold, or if you're above the threshold, or if you're registering voluntarily. You'll need to give your bank details so they know where to send funds for VAT refunds, and you'll need to let them know if you're registering for property development or letting purposes. And that's pretty much it when you're registering for VAT. When you'll go back to this form, you'll have a box here saying VAT, and then just click submit, and then Revenue will review your application. So the requirements for VAT registration are that you're trading and registered in Ireland, or you're a branch of a foreign business registered in Ireland. The evidence that will be required to show that you're resident in Ireland will be stuff like a certificate of incorporation, supplier or customer invoices. So it could be that you're trading with a supplier in Ireland, or you're selling to customers in Ireland, or you are yourself in Ireland, or you're hiring staff in Ireland, so you could show contracts for your staff, or you can show proof that the directors live in Ireland. If you can't prove any of this, Revenue may reject your application because you're deemed not to be an entity that has in any way any relationship with Ireland. So they basically don't want the hassle of dealing with you, so they'll reject your application. it can take up to 4 weeks to get the registration approved by revenue. But I've never really seen it go past a week, and even during coronavirus when everything was slowed down, it doesn't really take more than a week, but it can take up to 4 weeks. And generally what slows it down is if they feel that the company doesn't have a relationship to Ireland, that they want to request more documentation, and that will slow down the application. Okay. By the way, if you want to ask questions and you want to remember to ask them at the end, just send them in the chat and we'll look at them later. So then to talk about the charge to VAT. So when does a transaction fall under the remit of VAT? So we call them building blocks. So it has to hit all of these points. You have to be supplying a good or a service for consideration by a taxable person acting as such, where the place of supply is in the state. So that's the technical jargon. So basically, in a nutshell, there has to be a transfer of ownership of a product or service for money by a business conducting business in the Republic of Ireland. So to give you an example of that, if you walk into a cafe, you buy a cup of coffee, what's happened is you buy a cup of coffee for money. What's basically happened there is you've transferred the ownership of your money for coffee. The cafe is a business, it's conducting business at that point in time, and it's located in Ireland. So that it would come under the remit of VAT. To give you another example, let's say that coffee owner invites friends over for coffee, and they come in and they drink coffee. That coffee owner, that transaction is not a transaction for VAT purposes because there was no exchange of money, and the taxable person was not acting or conducting business at the time of inviting friends over for coffee. So there is a clear definition in law of what constitutes a VATable transaction. Another example of something that might not be considered VATable would be a busker on the street. So somebody gives a busker money. There was a case brought against the EU where they were arguing that busker is providing services, but the Court of the European Union stated that the money given was not consideration, so it was just a donation, so it wasn't VATable. So that struck off that from being a VATable transaction. Okay, to move on to VAT rates, there are several VAT rates that you need to be aware of, and you need to be aware of what your particular product or service, what category your particular product or service falls under. So 23% is the standard default rate, and at the moment the rate is 21% temporarily until the 28th of February, and that's to do with the coronavirus. It was written into budget 2021. But from the 1st of March 2021, it will revert back to the 23%. Then we have the reduced rate, which is 13.5%. And this is generally for tourism and hospitality, hairdressers, photography, restaurants, hotels, etc. There's a second reduced rate of 9%. And this is for newspapers, e-books, and sports facilities. Then we have a livestock rate for 4.5%. I'm not sure if that's going to be relevant for anyone on the call today. Then we have zero rated, which is 0%, and this would apply to books, children's clothing and shoes, medicines, tea, coffee, bread, and milk. And then there's exempt status, which means no VAT applies. And this is for financial services, educational services, and medical providers, such as doctors, dentists, etc. So the important thing to note at the moment as well with coronavirus and budgets, that the government has put tourism and hospitality back into the second reduced rate temporarily. That will probably in the future go back up to 13.5%, but at the moment it's 9%. The reason they do that is obviously to stimulate economic activity in those sectors. And the important distinguishing feature between the zero rated category and the exempt category is that if you sell children's books, clothes, medicines, etc. at a 0% rate of VAT, it means you do not charge VAT on those products, but you are allowed to claim VAT on all of your own purchases. Of any VAT that you've incurred, you're allowed to claim it back. With exempt status, you're essentially a consumer. You don't charge VAT on your products, but you also cannot reclaim VAT on any of your expenses to the business. So 0% is really the best rate to have your products at, because you can claim your VAT back, but with exempt you can't reclaim any. Okay. So to talk about VAT on goods, several factors to consider. You are a business, and you're going to be either sell to consumers or you're going to sell to other businesses, so B2C or B2B. And you're either going to be selling within Ireland, within the EU, or you're going to be selling outside the EU. And it really, like, you can see that there's a matrix developing here on what you're selling. You're selling a good, you are a business selling a good, could be to a consumer outside the EU, could be to a consumer in the EU, could be to a business in Ireland, could be to a business outside the EU. So there's a lot of scenarios that you need to understand to get your head around. So we'll cover off starting with consumers. If you're a business in Ireland selling goods to consumers in the Republic of Ireland, you have to charge 23% VAT, or you have to charge VAT, sorry, at the rate applicable to that product. And most of the time it will be 23%. By the way, sorry, just on the last slide, I have included a link to where you can find out if what rate your product or service is on the revenue website. They will tell. So if you're a dentist and you want to know, you just type in dental services and it will come up and tell you, you're VAT exempt. So if you're selling, anyway, by and large, generally, if you're selling goods to consumers in the Republic of Ireland, you have to charge VAT. If you're selling goods to consumers in the EU, so that's any of the EU countries except for Ireland, you have to register for VAT in that jurisdiction if you surpass the distance sales limit in that jurisdiction. Okay, so I know that can get very confusing, but every country in the EU has a distance sales limit, and I have that in this slide here. Ireland's, so if, let's say you have a German business selling computers to consumers in Ireland, if they sell more than 35,000, I'll just get my laser pointer here, sorry. They sell more than 35,000 euro worth of products in the year to Irish consumers, they actually have to register for VAT in Ireland and report VAT in Ireland. So likewise, if you plan on selling, I don't know, more than 50,000 euro or more than 35,000 euro, sorry, of products to consumers in Spain, you will have to register for VAT in Spain. Okay. If you're selling to consumers outside of the EU, it's 0% VAT. Okay, so you don't have to worry about VAT if you're selling goods to America, Canada, Australia, and if there's a hard Brexit or no deal Brexit, also the UK. So the UK will be essentially outside of the EU for VAT purposes come 1st of January 2021. If there's a deal, there may be, it may come into the remit of an EU jurisdiction, but we don't know yet. Okay. So let's say you're selling to other businesses. What if you're an Irish business selling to other businesses? If you're selling to other businesses in the state, you'll have to charge VAT at the rate that applies to that good. If you're selling to other businesses in the EU, so if you're selling to German businesses, Spanish businesses, etc., it's going to be 0%, but very importantly, you have to do two things. Number one, get the EU number, the EU VAT number for the company that you're supplying to. And number two, you have to put on your invoice 0% reverse charge, so that company in Germany or Spain or wherever it is knows that they have to account for the VAT in their own country on the reverse charge basis. And I'll go into more detail on that in another few slides. If you're a business in Ireland selling to other businesses in the United States, Canada, anywhere outside the EU, it's again 0%. You don't have to worry about VAT. And again, with VAT law, there are a lot of exceptions. So if you have very complex transactions where you're selling to other businesses around the world and you're not sure, I would really highly recommend you get advice from an accountant, either in that jurisdiction that you're selling to or in Ireland. Okay, VAT on services. So there is a different treatment for VAT on goods versus VAT on services. So again, several factors to consider. You are a business selling services to consumers, you're selling it to other businesses. you're selling it in Ireland, you might be selling it in the EU, and you might be selling it outside the EU. So if you're a business selling services to consumers in Ireland, again, you charge VAT. So whenever you're selling anything, goods or services to consumers or businesses in Ireland, always charge VAT. Pretty much is the golden rule. If you're selling it to consumers in the EU, you have to charge VAT at the rate that applies in Ireland. So it will be probably 23% or whatever VAT charges on that service. If you're selling it to other businesses, it's the same treatment as with goods. You have to tell them that it's a reverse charge of 0%, so they know that they have to self-account for it themselves. If you're selling services outside the EU to a business or a consumer, it's 0% VAT. So to go over that golden rule, whether you're selling services or goods, if you're selling it to consumers or businesses in Ireland, charge VAT at the rate that applies to that good or service. If you're selling it outside the EU, and probably the UK as well, it's 0% VAT. The tricky bit is when you're selling to other EU countries. Okay, that's really the tricky bit, for a variety of reasons, because of reverse charge mechanisms, self-accounting, doing VIES returns. It really becomes a mess when you're selling to other EU countries. And there's even a bunch of exceptions. So if you're selling services, you might be selling accounting services to a consumer in Spain who's considering moving over to Ireland for whatever reason. That's an exception, actually. Normally I would charge the rate that would apply in Ireland, but actually professional services are an exception to that rule. So there are a lot of exceptions that you need to be aware of, and really only an accountant would be aware of them because he deals with them every day. So it's worth checking. If you think you have a complicated situation, it's worth checking and getting advice. Just calling an accountant for 20 minutes, 30 minutes just to check, what VAT rate should I be charging on this transaction? Okay, now to go back into the Intra-EU supplies and VIES. So it's called self-accounting under the reverse charge mechanism. So if you buy goods or services from other businesses that are located in the EU, you have to self-account for VAT. And in a nutshell, it means you have to declare VAT as a sale and as an expense, and the net result is therefore zero. To give you an example of this, let's say you buy a laptop from Germany for €1,000. That German company will send you an invoice that will just say €1,000, reverse charge VAT at 0%, and the net amount will be €1,000 that you have to pay him. But if you're registered for VAT in Ireland, you have to self-account for the VAT as if the VAT was charged in Ireland. What that means is you have to multiply the laptop by 23% yourself. And let's say it was the only good that you had purchased in that VAT period and you're doing a VAT return, just for simplicity's sake. Let's say it was the only good you had bought. You hadn't sold anything. You'd just done one transaction in the whole VAT period. You bought a laptop for €1,000 from Germany. What you'd have to do is you'd have to put €210 here and €210 in T1. So €210 in T1, €210 in T2. T2 is subtracted from T1, so the net result would be zero. Okay. Now you might think, what's the point in that if it's zero? Okay, but it's really to tell revenue that you have been transacting with with other businesses in the EU. Okay, so it's really for revenue's benefit. So you'd have to do, at the end of your 2-month period, you have to do that for all goods and services that you purchase from other EU companies under the reverse charge mechanism. And likewise, if you sell products to other EU jurisdictions or services, you put on the invoice, like I said, 0% reverse charge, so they know to account for it. But you will have to start doing VIES reports every quarter. And that's basically telling revenue what you sold and who you sold it to. And it gets very complicated at this stage, but I will go through what a VIES return looks like. So, like I said before, when you're selling to the EU, to the company in another EU jurisdiction, you should get their VAT number, and you should say that it's a 0% reverse charge. The reason you need to get their VAT number is because when you go to do your VIES return at the end of the quarter, you need to put in their VAT number here and put in the value of the supply that you sent to them. So let's reverse it. Let's say you sold a laptop to a company in Germany. You would have to put in the value of the supply here of €1,000 and that German company's VAT number. And you'd have to do that for every single customer you send to. So obviously there are a lot of companies like, I would say, Googles and Facebooks of the world that have to do VIES returns. It gets incredibly complicated. It can be automated, so you don't have to do it, manually one by one. I mean, if you had like 100 customers, this would take you forever to do, but it can be automated. This is you only really need to use this form if you've got 5 or 6 sales that you need to take care of. Okay, in terms of the filing obligations, the VAT return deadline is 23 days after the last day of the period being reported. So in a nutshell, that means 23 days after the last day that you're doing the report for. So let's say we had a period January to February, the reporting deadline would be the 23rd of March. Most companies do bi-monthly VAT returns, so that's every Jan, Feb, March, April, May, June, July, August, etc. You need to file a VAT and pay any VAT that's owed over to the revenue within that 23 days. And you can only claim VAT and expenses paid if there is evidence that you've done this. So you need an invoice that shows that you paid VAT on a particular product or service. So the VAT return itself has 8 boxes. The boxes are called T1, T2, T3, T4, and E1, E2, ES1, and ES2. So T1 is all of the VAT that you've collected on your sales. So every time you sold, let's say you sold a widget for €50 and the VAT in it was €11.50. You would put the €11.50 in the T1 box. So it's a total of all of the VAT collected from your customers in that period. Your T2 is the VAT paid on any expenses and on any goods and services that you purchased. So for example, let's say you bought a laptop from a company in Cork instead of in Germany. You put in the €230 VAT on that invoice into your T2, into your box T2. Box T3 and T4 automatically calculate in the form itself. So T3, if T1 is bigger than T2, then you'll have an amount in T3, which is basically means you owe money to revenue. If T2 is bigger than T1, it means revenue owes you money. So like I said before at the start, for startups that don't have sales but have a lot of expenses, they will most likely have an amount in T4 going on for a number of reporting periods, and that basically will get refunded to your business, all the VAT you paid. Then we have E1, which is the net amount of sales of goods to the EU. So let's take the example of you selling a laptop to a German company. It was for €1,000. You would need to put that €1,000 into box E1. Let's say you flip that situation where you bought the laptop from Germany. You'd need to put the €1,000 into E2. And ES1 and ES2 are the same, except it's for services. That's all. That's the only difference. Okay, and this is what the VAT return, VAT3 return looks like. So you have your box T1 here, box T2. Then you press calculate. You have, and it'll put in a number in T3 or T4. T3 means you need to pay it. T4 means you'll get a refund. And then you have the E1, E2, ES1, and ES2 boxes down below. Some other things to note. At the start of the form, you'll need to pick what taxation period you're doing. So you need to pick the 2 months you're reporting for. You can click additional, and this is basically if you want to amend a prior period, you could click additional here. But be very careful. I've had a number of people come to me and say, oh, I've absolutely messed up. I've actually amended a previous return, and now I have to pay tax or whatever, and it really turns into a mess because you have to then go and amend it again. and it takes a while actually for these amendments to kick in. So I'd really be careful with this additional button. The other thing to note is that it asks you to indicate if there are any large purchases. So if you bought a car or a van or a load of laptops or anything of a capital nature, really, to put in yes, and that's just to indicate the revenue, because you might have a huge refund due, and it's just to indicate the revenue that it's because you bought capital items. Okay, so revenue would have checks in their own systems that highlight abnormalities, let's say, and you might get a VAT, you might get an audit, a VAT audit, if you've got consistent abnormalities without indicating that they were capital in nature. So as a startup, you might have purchased, a lot of laptops, a lot of software, so it's good to just indicate the revenue that these are unusual, and that they're once-off purchases. So then we have the penalties for non-compliance. So the link is on the slide here at the bottom right. The penalties for non-compliance are enormous, and it's not just, you can get penalized for doing so many things. So let's just go down through the list. So failure to register as an accountable person. So this is if you pass the threshold and you forget to register. They can whap on like €4,000 fine, as well as the amount of VAT that you owe, and as well as the pain of going through a VAT audit, because that's likely what they'll do afterwards to see the extent of the VAT that you owe. And basically what they will do there, if that does happen, let's say you were charging €100 going forever back for a product that you sell, what they'll do is they'll essentially say that that's the gross amount, and that a portion of that is VAT. So you'll take a whammy on that as well. You won't even be, it might suck up your whole gross margin, essentially. You can get a €4,000 fine for failing to charge VAT and pay it over to revenue. So again, if you get caught without registering, they can levy that fine on you, the first fine and the second fine. Both of them will get levied on you at the same time. Failure to keep proper books and records. So if you don't have a decent accounting system that's, records all your sales, they can decide to charge you or fine you €4,000. Failure to comply with invoicing requirements, and I highly recommend you check out that link. You don't really have to worry about the invoicing requirements if you have accounting software, because it basically takes care of it for you. They've followed the guidelines. But if you are producing invoices in Word or in Excel or whatever, I'd take a look at that invoicing requirement and just make sure you're abiding by it. It's mostly, you have to put in your VAT number, your registered address, who you are, who your customer is, the amount charged, the VAT charged, the total amount charged, etc. So there's quite a number of requirements that you have to meet, and I'd highly recommend you check out that link. Failure to furnish a quarterly statement of intra-community supplies. So this is the VIES return. So if you're selling to other companies in other EU jurisdictions and you fail to do VIES returns, you can get a €4,000 fine. Assisting in making incorrect returns. So this is actually for accountants. So if we assist businesses in making false returns or on invoices or credit notes, we can get a fine ourselves of €4,000, which is why very rarely you'll find an accountant who will help you dodge tax, basically, because we get lumped in and fined as well. Failure by flat rate pharma to issue invoice. Issuing a VAT invoice by a non-registered person. So let's say you are issuing VAT on your invoices, but you're not actually registered for VAT. You get a fine for that. Unauthorized charge of a flat rate addition. So this is when you think your product is zero rated, 0% VAT when it should be 21%. Willfully obstructing or delaying an officer in exercising their powers. So that's if you do get VAT audited and you refuse the entry to your building or refuse to hand over accounting records. Preventing or obstructing is pretty much the same thing. And then there's the last two don't really apply except in special circumstances, but you can look at them yourself. It's really the top 6 or 7 that you should be familiar with. Basically, just if you're not VAT registered, Two things: keep proper books and records. Make sure you're doing the invoicing requirements. And two, if you're not VAT registered, keep a record of the threshold limit. Make sure you don't bypass it or surpass it, sorry, in a 12-month period. So make sure if you don't want to register, don't want to be mandatorily registered for VAT, make sure you keep below that limit. So keep a rolling record of your 12 months sales.